Okay, let's just jump right into this explainer. We're going to break down how a stupid simple 5-minute daily routine can literally transform your trading consistency. If you're exhausted from watching your account bleed out, staring at messy charts all day long, you are absolutely in the right place. Today is all about one thing: preparation over prediction.
So, let me ask you, are you overcomplicating your trades? Look, so many of us spend years, blowing accounts and strategy hopping. You see a guy crushing it with basic support and resistance, then another trader making bank with complex institutional order flow, and the natural instinct, right? It's to mash them all together into some hybrid super strategy. But honestly, that complexity is exactly what's holding you back.
This dynamic right here perfectly illustrates the trap. Amateurs are out there trying to predict the market with these chaotic Frankenstein systems. Their charts look like a neon laser light show, totally driven by the fear of missing out. But then look at the consistent, profitable trader. Their chart is perfectly clean. They're just looking at pure price action, leaning on strict rules, and patiently waiting for the market to tip its hand. They prepare, they don't predict.
Here's our roadmap for today. First, we'll look at the overcomplicated trading trap. Second, we're going to build your 5-minute daily routine. Third, defining the trading range. Fourth, the breakout and retest. And finally, risk, discipline, and psychology. Let's get into it.
Section 1. The overcomplicated trading trap.
What's crazy is that when you stack a bunch of historical lagging indicators, things like moving averages or the RSI, in highly volatile markets, you actually become the liquidity that the big players are hunting for. Whether you're trading the S&P 500, the NASDAQ, or even Bitcoin and gold, lagging indicators just tell you what already happened, not what's happening right now. And dropping straight into a chaotic 1-minute chart without knowing your 4-hour or daily trend, it's literally like trying to run across a busy highway blindfolded. You're just going to get chopped to pieces because you have zero higher time frame context.
It really boils down to this. In trading, stupid simple always wins. It's a cliche for a reason. Quality of analysis will always beat the sheer quantity of overanalyzed trades. The more complicated you make your strategy, the more capital you're probably going to lose. Simplify the process and you fast-track your way to profitability.
Moving right along to Section 2, your 5-minute daily routine.
By following these 4 specific steps, you make sure you are only ever taking A-plus setups. Step 1. Check your higher time frame trend on the daily or 4-hour chart. Step 2. Mark your first 5 or 15-minute opening range. Step 3. Wait for a clean, definitive breakout. And Step 4, and this is absolutely the secret sauce here, execute only on the retest. Part of that higher time frame prep is spotting fair value gaps, or FVGs. Basically, when the market moves so fast and aggressive in one direction, it leaves behind an inefficiency, like a void. And the market absolutely hates voids. So price naturally acts like a giant magnet, trying to pull back and fill those gaps. Identifying these on your daily or 4-hour charts gives you a massive directional bias for the trading day.
Section 3. Defining the trading range.
Now, this is where the magic happens right after the open. These opening minutes establish the absolute balance of power between buyers and sellers. At exactly 9:30 a.m. Eastern, the New York session opens, volume floods the market, and our job? Our job is to literally sit on our hands. We don't guess, we don't anticipate. We just let that first 5 or 15-minute candle fully print and close. Once that opening candle is locked in, you just draw 2 simple lines. You mark the absolute highest point, the top wick, and the absolute lowest point of that candle. Boom, that's your box. That is your trading range for the session. No complex math, no crossing moving averages, just 2 distinct lines in the sand establishing your support and resistance.
Which brings us to Section 4, the breakout and retest.
I cannot stress this enough. Entering on the initial breakout is a huge trap that absolutely wrecks eager scalpers. So our golden rule is to always wait for the retest. Look, when you see a massive green candle rocket out of the top of your range, your heart rate spikes. FOMO kicks in hard and you think, I gotta get in right now. But if you buy that breakout, your stop loss has to be miles away to be safe. And 9 times out of 10, the market is specifically designed to pull back, trap those FOMO buyers, and stop them out.
That is exactly why we wait for the retest. A valid retest means the market actually tries to trade back inside our box, but fails. It shows the winning side is fiercely defending their new territory. So we need the entire candle body to close completely outside our range, not just a wick piercing through. Once it closes out, we take a breath and wait patiently for price to pull back and tap that broken level. If buyers step up and turn that old resistance into new support, that right there is your sniper entry.
Let's look at how this plays out with real setups. Take Micron, ticker MU. On a strong day, we get a clean 5-minute candle close above the pre-market high. We don't chase it, we wait for the pullback to tap that level, and then we enter long with calls. Now look at the S&P 500, SPY. We get a bearish close completely under the pre-market low. Again, we don't chase the drop, we let it pop back up, watch it fail at the retest of the low, and then we enter short with puts. It is a super low-risk setup with a massive potential reward.
Section 5. Risk, Discipline, and Psychology. All the strategy in the world means nothing without this, the 0.5. You have to place your stop loss exactly at the 0.5, or the midpoint of your opening range. If you draw a Fibonacci retracement from the top to the bottom of your opening candle, it gives you this exact line automatically. If price breaks back into the box and travels past that midpoint, the breakout has failed. You cut the trade. No hoping, no holding. Just cut it. And that leads right into our non-negotiable rules. Define your exact risk before you ever click buy. Target a minimum 2-to-1 risk-to-reward ratio. And most importantly, if you take a loss on a totally valid setup, accept it and walk away. The absolute worst thing you can do is start revenge trading or tweaking your strategy on the fly. Take your base hits, manage your risk, and step away from the desk once the setup is complete.
Check this out. This really proves why discipline is everything. A 30-day backtest of this exact opening range retest strategy yielded a 70% win rate. Over 20 trading days, this mechanical approach printed highly consistent profits with incredibly low drawdown. But hey, look at that 30% loss slice. Losses are gonna happen. It's a mathematical certainty. Traders blow up when they hit a totally normal, statistically expected loss, panic, and completely change their system.
Always remember this. You are trying to be successful over time, not every time. Trading is just a giant probability game, a tug of war. You have to give your statistical edge the actual time it needs to play out over a series of trades rather than living and dying by a single 5-minute chart. If your edge wins 7 out of 10 times, your only real job is to execute that exact same setup 100 times in a row without letting your emotions sabotage the math.
So, as we wrap up this explainer, I really want you to ask yourself, what is the very first thing you check every day before opening a trade? Seriously, are you actively hunting for an excuse to enter the market, or are you patiently waiting for the market to actually prove its direction to you? Clean up your charts, wait for the retest, and trust your preparation. The market is not a casino. Well, not unless you treat it like one. Thanks for hanging out with me today, and I'll catch you on the next explainer.